Good evening, everybody. Welcome to another session of Option Wednesdays. I'm your host, Prashanth Lalu from Kotak Securities. In the previous segment, you had learned about the basics of derivatives, the pricing of options, the Greeks, and also a bit about how to write calls against your portfolios. So these are the major topics that we covered previously. And in today's session, you're going to know about trading options. These are strictly on intraday basis. What are the parameters that you need to keep in mind when you get into an option trade? And what is the kind of risk management you have to adhere to? And also how to gauge the sentiment of the market so that you choose the right direction, whether to buy a call or a put, or whether to write options. So these are the topics that we will be covering in today's sessions. So let's get on with it. Can I have the presentation, please? Right. So the first important thing is, what are the questions you need to ask yourself before you get into a trade? So what's the direction of the market? Is the direction going to be bullish? Let's say if the market has open gap up, is there going to be more buying happening after that? Or is it going to be mute? Or is it going to give up all the gains? This is something which is very important, and 50% of your work is done once you decide which direction the market is going to go. And after that, it all comes down to your strike selection, whether you're going to buy an ATM or a slightly out of the money option, whether you're going to be a buyer or are you going to sell options, whether it can be call option or put option based on again your view. So if you go to see, the strike selections also is integrated into whether you're going to be a buyer of the option, because if you're a buyer, you would probably look at ATM or slightly out of the money, and if you're a seller of the option, you would probably go deep out of the money. And how do you gauge it? What is the derivative data that you're going to take into consideration, whether it's going to be the PCR ratio or the open interest? So, what determines your trade? And what data you need to take into consideration before you get into the trade? And most importantly, what stop losses you choose. Now, the stop loss for a buyer will be different, and if you're a seller of the option, it's going to be different. So let's see. Once you answer, you have the answers to all these 5 important questions, then you can get on with your trade. So once you follow these rules, what happens is the probability of you going right on the trade would be much more higher. So please remember these 5 questions, and because this is what determines your profitability of your trade. So how do you choose the direction of the market, whether it's going to be long, short, or sideways? Because as I said, 50% of your work is done once you decide what is the direction that the market would be for any given day. So, as I gave you an example, uh, if the market opens gap up, is it going to continue to gain through the day, or is it going to be a muted session, or is it going to give up all its gains and go down? So, how do you gauge that? How do you gauge the sentiment of the market? That's the most important question. So, let's say you're trading Bank Nifty. So if you go to see HDFC, ICICI, SBI, Axis, and probably Kotak form the heavyweights of the banking index. Now, all you have to do is once the market opens, you see where these stocks are trading at. Are they trading positively? Is there a buying interest in these heavyweights? Is the volume going up? So then, if these parameters are met, then the direction for the current day is probably going to be higher. And if you see a buying interest, which means you see the volume as well as the price rise, then you can come to a conclusion saying that, okay, the bank nifty might go little higher, and you can choose a right strike. So let's say if, for example, HDFC has opened positively, but the rest of the banks are all trading, sideways. There is no real movement, or there's no buying interest or selling interest in those stocks. So what happens then is HDFC alone could probably take the market to a certain degree, but if the rest of the stocks don't support it, so the chances are that it might open positive and then trade sideways throughout the day. So in such a scenario, even if you buy an option, the probability that you would make money would be far lesser, because you might just lose on time value. Now, since the weekly options are available, most of us, when it comes to intraday, we'll be trading weekly options, because the momentum and the premium gained and lost will be higher in the weekly options. So once the direction is established, what is the strike price that you need to select? So, for example, when you're trading weekly options, and you're a buyer in the market, Fridays and Mondays, you would probably be okay with trading, slightly out of the money options, because the time value will favor you. So because on Friday, when you take an option to trade intraday, you still have Monday to Thursday, which is 4 days for you to, for the stock to actually, or bank nifty to go up. So what happens is, even if you buy slightly out of the money option, the chances of you making money is much more higher. And of course, the other thing to keep in mind is that on Friday, the option premiums also will be much higher. So what happens once if you're a buyer and you want to buy an option on Tuesdays or Wednesdays or even on expiry days? Now, what happens is, if you buy an OTM, the chances are, if the market does not move up significantly, then you would lose on time value. So the option premium might deteriorate, even though the market might come up, and the chances of you making any kind of profit would be lesser. So the most important thing to keep in mind is, when you are trading or buying an option on, let's say, probably Tuesday, Wednesdays, or Thursdays, you should come closer to the ATM, or even trade on ATM options only. Okay, now that is with regard to the buyer. Now, what about the seller? For the seller, what he can do is, once he's gained the direction once he comes up with a view that this is where the market is going to go, what he can do is, he can take a significant, deep out of the money option, either the call or the put, and go ahead and write it. So, for example, if Bank Nifty is trading at, let's say, 38,000. So today, I'll give an example of today's trade. Today, Bank Nifty opened, and it opened flat at about 38,200, 38,300. So the 39,000 call option was trading at about 32, 33. So considering there is only one day to expire, I thought the premiums were slightly high, and since I gauged that the market is going to be muted for today, the chances of making money on writing of options was higher. Now, what would have happened if I had bought a call or a put, considering the market moved 100% 100 points positive, 100, 150 points positive, and then it came back. So unless I would have bought the ATM, I wouldn't have made any money as such on either direction. So since I knew that the market is going to be within a range, it would be more prudent for me to sell options rather than going and buying the option. So, as the example, as I stated, I wrote the 39,000 call option at around 32, 33 rupees. And by the end, it closed at about 18 or 19 rupees. So, that is the kind of trade that I took. And it was a profitable trade. So this is something that you have to keep in mind. Whereas if the market is muted, and if you're only a buyer in the market, you either trade on the at the money options, or you could even miss today and then come back tomorrow and see if you have a direction in the market, either on the long side or on the downside, and then pick up a call or a put. Now, the other thing is, how do you know the range of the market? There comes the data part. Where is the open interest line? For example, in this series, the open interest for Bank Nifty was at 38,000 put options and 38,500 call options. So, which means the chances that the Bank Nifty will breach these 2 points of 38,000 and 38,500 is negligible. It's not impossible because anything can happen in the market. So if you're an option writer, what you would probably do is look at strikes below 38,000 and look at strikes above 38,500. And if you're a buyer, you would probably look at options, at ATM, which I already told you about, at 38,200 or 38,300, either the call or the put. So open interest plays a big part in your strike selection, both for the buyer and the seller of the options. Now, buying and selling of order flow. This is something that I explained to you, that when the market opens, you concentrate on the heavyweights. So when you just look at five stocks, what you're doing is you're eliminating all the noise around you. So you just have to concentrate on those five stocks, which are the heavyweights in Bank Nifty. Or if you're trading in Nifty, you could have a view on Reliance, ITC, TCS, and probably HDFC Bank, because these constitute about 50-60% of the weightage on the Nifty. So, that is something that you can keep in mind to gauge the view of the market, or whichever direction it might move during the day. Now, all of this is for pure intraday trading. Now, the other important factor is the time to expiry. This is important, as I told you, because on Thursday, if you come and buy an out of the money option, either on the call side or the put side, or even on Wednesday, because there is time decay, the chances of going wrong in the trade is higher, unless you know that the market is going to make a huge move on either side, on either direction. So keep in mind how far the expiry is when you're trading options, and also take into consideration the ATMs, and for example, as I said, on Tuesdays and Wednesdays, try and trade on ATMs than OTMs. I'm repeating this because a lot of us, we choose the direction of the market, right, and unfortunately we take the wrong strike, and you don't end up making money even if the market moves in your direction. Now, maintaining stop loss. Most people don't keep a stop loss when it comes to trading options. But especially if you're writing option, the loss can be unlimited. So it is very important to maintain a stop loss. Even if you're a buyer, if you're buying an option at probably 100 rupees, it is prudent that you keep a stop loss of at least 50 rupees on an intraday basis, because that is the kind of if the market is volatile, that is probably the maximum amount you can keep. And if the market is not that volatile, you can keep a smaller stop loss. Now, if you're a writer of the option, what is the ideal stop loss you are supposed to keep? So let's say you sell an option for 50 rupees. The max loss that you should be willing to take is 50 rupees. That means 100 rupees should be your stop loss, which means your max loss is 50. So the ratio is basically 1:1. So either you gain 50 rupees or you lose 50 rupees. So that is the maximum stop loss you need to keep if you are a writer of an option or a seller of an option. And it is, as I told you, since the losses are unlimited, when you write options, it is very, very important that you maintain a stop loss. I mean, you can get the direction wrong, choose the wrong strike prices. You can always come back another day and get your trade right. But if you don't have a strict stop loss, it could wipe out a significant amount of your capital. So please pay attention and keep a stop loss for every trade. And last not the least, what you need to know is when to exit out of the position. For example, if you're a buyer of an option, it is not necessary that you need to double your option on every trade. If you can do it, that is brilliant. But the chances of that happening every day is not significantly higher. So let's say you buy an option for maybe 100 rupees, and what you can do is square off the whole option if it comes to 130 or 140. Or what you can also do is you can trail your stop loss to 120 or something like that, so that you at least get some amount of profits. So usually what people do is they wait for the option to double, and they must have I'm sure you would have heard that I've doubled my profits or tripled my profits, but that does not happen every single day. So any amount of profit, it can be 40% or 50%, it is okay to exit, because you always have a brand new day to come back and have a new trade. And the other thing is, let's say you get the direction wrong. It is advisable that it's okay, don't wait for the option to become zero, or you don't even have to wait for the option to hit your stop losses. Let's say you buy an option and suddenly you see a sell-off in the market. It is not necessary that it has to hit your stop loss or the option has to become zero. You can square it off at any given point of time and get a new trade. So these are the key points that you need to keep in mind. Again, going through direction, the strike selection, what is the data you're going to back to prove that you're on the right side of the market. Check the order flow, see the heavyweights, how they are performing. Keep in mind the time to expiry, so that the time decay doesn't get the better of you. Most importantly, maintaining of stop losses. Okay, now you have gone through this previously, how the option premium works and how it is calculated. And this is connected to the previous slide, where it is important to know where the spot price is, what strike to pick up, depending on whether you're a buyer or a seller of an option. And again, the time decay to time to expiry. Of course, if the volatility increases and if you're a option writer, the premiums will be higher, and the chances of you getting higher premiums are there. But also, if it is extremely volatile, it's prudent for you to keep a stop loss, and so that you don't end up having huge losses. So, as I explained to you, how I, as a research analyst, select my trade. I take a broader perspective of the market. Since I trade more on Bank Nifty, broader market view is where are those 4 or 5 stocks trading on any given day once the market opens. Again, whether there is a sell-off in either of the stocks, or is there a buying interest, or vice versa if there is a huge sell-off. Intraday dynamics of the Bank Nifty again constitutes the same thing. As I said, scanning heavyweights like HDFC, SBI, ICICI, and Axis. This is important. Option data. Option data again for the weekly options. Usually, it will be within a band of probably 500 points. And secondly, the other thing is, if there is a result of a heavyweight like HDFC, or if there is a RBI policy or something like that, then usually that day it is best that you keep away from trading bank nifty, and especially if you're a writer, uh, it is better off to keep away. And if you're a buyer, it's okay, because your losses are limited. But if you're a seller, please do keep the stop loss. Ideally, we don't dwell into giving trades if there is an RBI policy or anything like that. And only after the policy is done or a result is done, then we gauge the market again and the market dynamics, and then we give a trade. A selection of strike prices. This is again important on an intraday basis. If you're trading, if you're a buyer, it's best to look at options which are priced to a max of maybe 100 rupees. And if you're a seller, I mean, you wouldn't probably get these kind of premiums at OTM. So you would be looking at something around 50 or 60 rupees when you write OTM or out of the money options. And except on the expiry day, the for a seller, the option price is not going to become zero. So even if you write an option at about 60 rupees, you should be good to square off the option on intraday basis if it comes to 30 or below. So selection of strike is important, as I've mentioned. And along with that, now you know that selection of premiums are also equally important, because let's say you pay a premium of probably 200 or 275 rupees buying the ATM at the money options, and let's say the market does not move. What happens is the time decay will just erode your option premium, and you just end up losing a significant amount of money. So along with strike, please keep in mind to select the premiums also, which are appropriate. Now, what are the strategies that we at Kotak give? So, if you are bullish, as I told you, we would go ahead and buy the call option again, depending on which day of the week I'm buying the option. If I'm buying on Wednesday or Thursday, I would probably look at the ATM, and or if I think, even though the view is bullish, but it's not significantly bullish, where I can make a significant amount of money, even though the market might move in the direction I choose. What I would do is I would write a put option or short a put option, where I'm pretty sure that the option premium would probably go to zero. And if I had vis-a-vis, if I had bought a call, I wouldn't have made a significant amount of profit. So you have to decide how much the market might move. In Nifty, if you're looking at Nifty, if Nifty moves by about 50 or 60 points, again, depending on which day it is, you may not make a significant amount of profit if you're a buyer of an option, for example, on a Tuesday or something like that. But if you write a put option, the chances are that yes, you could probably make money even if the market goes up just 50 points, and you would gain the premium which is eroded due to time value and the direction. And vice versa, if my view is negative, I would if my view is significantly negative, then I would definitely go and buy the put option. But if not, for example, like today, where I knew the range is going to be very small, and in the morning when the market opened flat, and I saw the order flow, which proved it might go down for a bit. What I did was I wrote a call option. So these are the dynamics that you have to keep in mind to when you come to trading options, whether you want to be a buyer or you want to be a seller of the option. This is something which we do almost on a daily basis. What we do is we check the OI, open interest, and we see where we can get a significant amount of premium on either side, either on the both on the call side as well as the put side, and we uh, write both the options. Now, like for example, today what we did was we the trade I gave was to write the 39,100 call option and the 37,300 put option. Now, if you go to see on the call side, it was from the ATM, it was about 800 points away, and on the put side, it was about 1,000 points away. So both put together, I was getting a premium of about 52 rupees. And by the end of the day, the premiums had come down to 28. So, I made about 20, 22 rupees, 24 rupees profit. And that is good enough on an intraday basis. Now, this would become zero if you do it on, on expiry day. And of course, the market again has to be within that range. Now, how do you gauge the range? Yes, you one is, of course, you check the open interest. So as I told you, for Bank Nifty, it was 38,000 put options and 38,500 call option. And on the Nifties, it is 17,400 on the put side and 17,600 and 18,000 on the call side. So you know that it's going to be in this range. So anything below that, if you're getting a good premium, you could take a chance and write those options on either side. And this particular strategy has proved has worked well for us, and we definitely recommend it on a daily basis, uh, choosing the right strikes. Now, these are some live trades that we had given previously. For example, at 9:22, a few weeks ago, we had sold Bank Nifty call options of 33,500 at about 60 rupees. And as you can see, during the day itself, it had become half at 31. So this is profitable trade, and in terms of percentage, also it is uh, giving you a good return. And this is something that we do when we are writing options, and vice versa. Once this was done, we also looked at selling of put options, when the direction change. Now, we do it on a dynamic basis, but as a trader, if you can get even one single trade right every day, that is good enough. And the thing is, if you want to be so dynamic, you definitely have to be in front of your screen to execute or your trades. Of course, we have the option of trading through our app, and that would be easier for you to do. And especially while writing options, please make sure that you keep stop loss, because as you know, that if the uh, direction goes against you, the losses can be significant. So stop loss is very important, and whether you are a buyer or a seller, it is something that we have seen a lot of traders don't adhere to. And when they get stuck in the trade, wherein we have actually given a stop loss and it goes beyond it, then they are actually in trouble. So please maintain a stop loss at all given points in time. And these are the rules that I follow. Now, since I talk about intraday and I'm bound to trading and giving recommendations on intraday, I never carry forward the position. Most times, what happens is, let's say you buy an option and it's not giving you a certain amount of profit on a particular day. You would probably think of carrying it to the next day and say, okay, why not carry for another day, and see if the market goes in my favor tomorrow. But what you don't know is it can go against you also, and the loss of probably 10 rupees that you're making today might go up to 50 rupees. So an intraday trade is an intraday trade. Get out of the position by 3 o'clock or 3:15, or if whenever you're when it's going against you, or if you've made enough profit, and if you haven't made a significant amount of profit or a loss, I would still advise you to get out of the trade, because it was purely a intraday trade, and because the next day the dynamics of the market can be completely different, and you don't want to be stuck on the wrong side. So that is rule number one. And then book profits. You see an amount of profit, you take it, and you could probably have take a break and then come back for a new trade. So once you take a profit, you're out of the trade, you're free, and that gives you another chance to see if there is another trade in the market, or if the direction has changed. So never try and as I said, try and pick singles than hit sixes, which means every trade need not double your money. If you bought a option for 100, it's okay if you book it at 140 or 150. It need not go to 200. So that is something. Booking profits is as good as cutting your losses also when it comes to options. Exit if you're in doubt. You take a trade and suddenly the market is goes flat, there is no movement, and you see some of the heavyweight stocks going against you. It's okay, you got the trade wrong, you exit out of the position, and then come back and see what are the go back to the parameters, and see what is working or what has gone against you, and see if you can find a different trade. Or you close a trade for today and you could come back tomorrow, which is a brand new day. So adhere to stop loss. Again, I'm stressing on this, especially not just even if you're a buyer, but as a seller, because the losses will be significant if you don't adhere to stop losses. And especially during result seasons, the volatility will be more. And if you're trading stock options, I would advise not to trade during on the result season. And even if you trade, try and buy options, because your losses are limited. And yes, every day is a brand new day. So if you get it wrong today, it's okay. You can come back tomorrow and uh, see go through the parameters, the direction, the strikes, all of that, and get a new trade, right? So the common mistakes that I have witnessed over these years is holding on to hope, which means that, as I said, maybe the market would reverse and you might get your price. Maybe it reverses tomorrow or the day after. But what happens if it does not happen? Especially when you're trading options, the chances of it going against you would probably be higher if you not gauge it right, if you haven't gauged the direction right, or haven't selected a appropriate strike price. And the other thing is, do not average options. A lot of people tend to do that. This is not a stock. The option price can go to zero. So I wouldn't advise you to average options. If if the prices go down, strike selection, yes, again, even if you choose the direction right and your strike selection is wrong, the chances are you are not going to you know uh, make that kind of profit you are looking for. Oblivion to the time decay, theta factor, very important. Please keep in mind as to how many days are there to expire, and it causes a significant amount of erosion in options, especially if you're uh, buying options. But if you're a seller, then decay of options is good for you. Theta is your friend. So last but not least, one can go wrong in determining the direction, the strike price, and fail to determine the theta. But maintaining a stop loss is very much in your hands. So please maintain a stop loss, and keep the risk management in your hand. and not let the market erode your profits or your premiums. So this is of course for the buyers, and if the premiums erode for the seller, it's good for him. But more importantly, keep the stop loss, and keep an appropriate stop loss. So that's the end of the session on trading, intraday trading of options. We will open up the Q&A section now. So one has asked, on expiry day, what is the good time if I want to buy a call? Well, there is no good time as such. Again, you need to go back. Let's say on expiry day, the market opens flat, and you see that some of the stocks, the heavyweight stocks, are gaining strength, gaining momentum along with volumes. Then you obviously go ahead and buy the call. So what you can do is, again, if you're trading on expiry day, I would advise you to buy the ATM call option at the money, because the chances of you making any amount of profit would be higher. So expiry day trades, always trade ATMs. That would be prudent for you. And of course, once you only get the direction of the market right, then you go ahead and buy the call or the put. So someone has asked, how do I find out the OI on uh, the Bank Nifty or Nifty? Usually these are available on even on the NSE site or on our trading app, or so the open interest is available everywhere. What I would also advise you is, along with the open interest, see whether there is a addition or reduction in the open interest. This would play a vital important piece of data, because if the open interest is reducing, that would signify that there could be a breach of the OI. So that is something that you have to keep in mind, whether the open interest is increasing or decreasing. What is the right stop loss to take for the trade? Yes, as I told you, if you are a seller of the option, uh, the maximum stop loss you would need to keep is double the option premium. And if you're a buyer of the option, 50% would be good. If you're buying an option for at rupees 50, it is best to keep a stop loss of 25. But more importantly, keep a stop loss. Okay. Which you prefer, option buyers or sellers? Now, I think that is based on each individual. As you know, if you're option buyer, the you just have to pay for the premium, and the premium amount is will be lesser. But if you're a seller of the option, it is the margin you have to pay is almost like buying a future. So that completely depends on the individual. Uh, of course, if you're an option seller, again, you choose the OTM strikes out of the money, and where the premiums are lesser, and where your margin also will be lesser. But compared to buyers, the option seller always pays a huge premium. I mean, for an option buyer, your Premium could be as low as probably 2,000 rupees for a lot, but for if you're a seller, it could easily, it will be ideally about 1 lakh 40 for 1 lot if you're selling of options. So yes, it completely depends on you and your capacity. So that is what I would suggest. So I think that's it for now. I've covered the major questions that, and most of the questions are repetitive. So I hope you enjoyed the session, and keep in mind to keep prudent stop loss and the 5 rules before you get into a trade, which is the direction, strike price, have a view on the open interest where it is, and most importantly, stop loss. Thank you.